Yeah. We're live on Facebook, we're live on Instagram. We're live on Facebook and we're live on YouTube today. I just want to welcome you to this program. We're going to have a great conversation this afternoon, and I just want to welcome you today. The topic of our discussion today is we're talking about real estate and taxes. We're talking about real estate and wealth building. So guys, let's go. I think it's 3 p.m. It's 3:01 p.m. here in Texas, in Houston, Texas, and we just going to get started. So I want to welcome you all and thank you for taking the time to be part of this conversation today. It's a training. It's also, I mean, we get to learn. These are things that we talk about, and we just want to make sure that we are aware of these things. They are out there that we can use them as well. I just want to give a disclaimer here. This is not a consultation. It's just, I'm just giving, some of them might just be my opinions. And as you take them and implement them, or if you need more guidance or you need a consultation, we're here to serve you. But in the meantime, it's important that you know that these things are out there for you. You can take advantage of them, you can use them. And that's why we're having this every week to talk about these things. I'm also just going to use this platform also to basically tell you some of the things that we'll be doing. I mean, I want to tell you some of the things that we'll be doing in the next coming weeks, next coming months. Let me see. Sure, I just want to do. Let me see. Nope. Give me 1 second. I want to make sure I'm getting proper. Yeah. So again, thank you for this. Today we're talking about something that is very important, and I just want to make sure that we all take advantage of this. Okay, let's get started. It's 3:03 here in Houston, Texas. Let's get started. I'm going to share my screen with you, and then we're going to get started. True. Yes, thank you. And I want to make my slideshow perfect. Again, we're talking about how investing in real estate makes you wealthy and saves a lot in taxes. So let's talk about it. Let's get going. So basically, I'll tell you this, the American dream is alive and it's available for you to take it and run away with it. We are going to use this. We're going to take it and we'll run away with it. Okay, we say here that the American dream, I said that today we're going to be talking about how investing in real estate makes you wealthy and how it also saves you a lot in taxes. I mean, I'm so interested in the part of taxes, but I also talk about the part of wealth as well, because there's a lot of wealth in real estate. And the reality is most people and all my clients who are in real estate, all my clients, wealthy clients are in real estate. And so I just think that is the way. And I know that that's the way. That's why I want to talk about it. The American dream is in the tax code. The American dream is alive. The mighty and the powerful understand this and have taken advantage of this for years. We should be taking advantage of this as well. We should be taking advantage of the American dream. And this is part of the American dream. So what I'm talking about today is something that I know it works. I know I've implemented it over the years. It works perfect. So we want to implement it as well. Today, I want to tell you one thing. Smart communities are taking advantage of this. Like I said, 99% of the wealthy people, they all invest in real estate. And if they are, there's something about real estate that we must take advantage of it. And the big thing is that everybody in real estate, when you buy real estate, you're able to avoid taxes. When you invest in real estate, you're able to avoid taxes. You are able to build wealth. So let's take advantage of this. Smart communities are taking advantage of this. We are also going to take advantage of this. One thing I'm going to say is that politics and economics, they always work together. Remember, I told you that the American dream is in the tax code. That's why all the wealthy people, they lobby across Washington to know exactly what these people have to offer them. Because when those people go to Washington, they are working, they are also trying, people are trying to get their interests made. And we want to take advantage of anything, all of what these top people are making happen. You cannot be passive on what's happening. You cannot be passive. Why are you not passive? You cannot be passive because what's happening in this down there in Washington is impacting your life, it's impacting our lives. And when we elect people, we need to know, first of all, what are they doing for us? What is in their game for us? What are they going to do for us? Even though they are not the guys, they are the ones who set the rules. They are the ones who make those rules. And we play by the rules. So we cannot stay away from all these things happening. The top Americans, they don't stay away from politics because they know politics is what is helping them. So my name is Charles Njoya. I'm a CPA. I'm a certified tax advisor. I'm a wealth coach. And I'm also a mainstream tax advisor. And that's with the Marcola Group. And I want to say that because I'm really proud to be part of that group, and that group does a lot for me. So I think it's something I just wanted to say here. Gosh, the topic today is what? How investing in real estate makes you wealthy and saves a lot in taxes. So when we talk of real estate, what are we talking about? We're talking about, first of all, we're talking land and anything that's permanent, any permanent structure attached to land is part of real estate. We talk about commercial property, we talk about residential property. And then let's talk about some investment options in real estate. We talk about commercial property, promissory notes, apartment buildings, hard money lending, low income housing. These are all things that are available for you when you're in real estate. Mobile homes, vacation properties, storage units, duplexes, condominiums, and land. All of this is part of real estate. So the myth in this area is that people will tell you that real estate is loss making. On paper, real estate is loss-making, but the reality is that real estate gives you a lot to play with. What you're looking for when you invest is a return on investment. Real estate on paper is loss-making, but in reality, the return on investment in real estate is huge. And that's why real estate people who invest in real estate, they tend not to pay taxes because the foundation, maybe the premise around real estate is that it's going to make losses. And why does it make losses? We'll talk about those losses. Real estate is for wealthy people. That's another myth. People believe that you only invest in real estate when you're wealthy. That is a myth. But I'm going to tell you, if you don't have income yet and you're looking for real estate as the place where you're going to make income, it may be hard for you to start because real estate, unless you're doing things like flipping, but what we're talking about here is not just getting into flipping and doing those things that you're going to convert into cash as quickly as possible. Here we're talking about long-term. We're talking about long-term investment. You could flip, you could do all those things. That will give you that participation that you call getting the real estate professional status, which might give you a lot of tax benefits. But when you go into real estate, you're thinking long-term. That is so important that you think that real estate is going to create value for you long-term. It's going to create something called assets, but it's going to create value for you long-term. So another thing, when we talk about wealth, what do we mean? And I've talked about real estate because when I talk about I talk about how investing in real estate is going to make you wealthy and save you a lot in taxes. What we're looking for, the term real estate, we've already told you what we're talking about when we talk about real estate here. What is wealth? Wealth is the accumulation of assets. Wealth is anything that creates money for you when you're asleep. It's going to be wealth. And this is our definition. This is the definition that we want to mainly kind of expand on. Anything that is sellable for value is going to be an element of wealth. Anything that does not require substantial cash outflows. If you're investing in something and that thing is taking a lot of money out of you, it's not building wealth for you. It's basically taking your cash out. It's basically taking a lot of cash out of you. That's why some of the things that people call wealth I mean, I look at them as not being elements of wealth. They're just you're investing, but you're taking a lot of money out. You want to look at those things that stop you taking money out, but also are building your assets. So how it makes you wealthy? How does investing in real estate make you wealthy? One, I want to show you something called the trifecta. When I talk about the trifecta, it's something I should have. This is the creation. This is something. I'm going to go back to my screen and I'll show you a trifecta. When I call it trifecta, I'll give you, let me just open a trifecta and then we can look at it. And I'll tell you what when you talk about the structure of, talk about structure. Let's see, quick one. Let's see. I'm just going to go through this. Quick one, guys, just bear with me here. I'm going to use my own to draw my screen. I'm going to share my screen with you, and then you can see what I mean here. So when we talk about wealth, we're talking about this. I'm going to share my screen up here. Let's go. Okay. So when I talk about wealth, you always think about it in this form. And I hope you're seeing you're seeing my drawings on the board. Let me do that. Perfect. I don't want to take all of your time, guys. Today has been a hectic day for me. So basically, you think about wealth. Below here, you have your revocable living trust, which is the foundation of your estate from a legal standpoint. And then below, you have your 1040, which is your tax return. And then you divide your estate into two. On the right side, you have everything that is assets. Anything that is passive activity is called assets here. And then on the left side, you have your operations here. Oh, come on. Operations. Anything that is active here is operations. Anything, when we talk about assets, this is anything that is creating the dollars for you while you're sleeping. When you talk about operations, this is what you're working on a daily basis and working money. It could be a W-2. It could be also a business that you have that's generating income for you. It could be a sole proprietorship. And then you could have another businesses. All of these items, maybe another LLC here. And this LLC has maybe an S-Corp, which is making money. All of these are owned by your revocable living trusts. What is all this side here is everything that you're doing on a daily basis. You're using you're using your ability to create income on this side. This is ordinary income. You create ordinary income on this side. On this side, you have maybe an LLC that owns assets. Maybe it owns real estate. It owns crypto. So basically, the way you structure this real estate, you can put them in LLCs, and you can have many other structures on here. But again, anything that is on the right side of your trifecta, we can talk about this in more detail, is going to be what you consider assets for you. This is what makes you wealthy. Income does not make you wealthy. Income just gives you income. It is what you receive on a daily basis. But what you make of it is what's going to determine you. That's going to create your wealth. So most of the time, we help people to use this income to build assets. So assets on this side are what makes you wealthy. Income doesn't make you wealthy. That's what we call wealth. So wealth is everything that's on the right side of your trifecta. And on here, you could have cryptos, you could have rental properties, you could have maybe investment in stocks, all these different types. You could have land. I mean, you could have a farm, all those things that you're not working on a daily basis. All those are the things that you consider wealth. Having said that, let's go back to our previous screen and continue with our presentation. Yep. Okay. Yeah. So we now know what wealth is all about. Let's proceed. So we've talked about the trifecta. I just showed you the trifecta. The other thing is here, who is who and why invest in real estate. This is very important. Your ability to power to the ability to and the power to leverage, the ability and the power to leverage. What does that mean? It means that you are basically, what does real estate give to you? Why do you want to invest? You are leveraging other people's money when it comes to real estate. For most of those assets we talked about, you basically go and buy them, you spend to get them. But with real estate, you're basically, what are you doing? You're leveraging, you put 10% down, and then you have access to 100%. Somebody's money is giving you access to that money. You have the ability to leverage. The other one, you save money. Saving money is, real estate will allow you to save money. You're putting money in an asset you already leverage. You're buying an asset, you're putting down very little, and you're having assets, you're having access to a huge asset that you can save money in. It's a saving mechanism. Another thing, it allows you to grow money fast at a faster rate. And I'll show you that. That's the reason we're talking about this today. Real estate allows you to grow money at a faster rate, very fast rate. And I'll show you why I said that. And then real estate gives you tax savings. A very big portion of this is tax savings. People who are in real estate, who are qualified as real estate professionals, they tend not to pay taxes. And we'll talk about that as well. Creating income for the future. When you are thinking about real estate, like I said before, there are many people who come into real estate because they want to make money. If you want to make money in real estate, you want to turn money now, you can do flips. You can go into doing flipping. If you're flipping, you're basically buying and selling property right now. It's going to create you money. But if you're thinking about investing, if you're thinking about creating wealth out of that real estate, it's all about long term. So you're creating income for the future, not now. You're working with family. That's one of the things that real estate allows you. You can do a lot of things because, again, you're creating a business for yourself, and then you can work with your family. You allow your family work into it, and they get to understand it. Control. Most of those other things that you buy, you don't have control over. Let's say you bought crypto, you're just listening and seeing what the market is performing like. You buy stocks, you don't have control of what's happening with the stocks. But when you buy real estate, you have control. You have the key to that property. The market could be volatile, but you own that property. So you have control over the property. One other thing is forced retirement plan. Some people, savings is one of the things that is hard for many people. If you cannot save, why not invest in real estate? When you invest in real estate, you are investing just a fraction of the money, and you're using other people's money to buy you a huge asset that you can leverage right now. And if you can do that, that's a forced retirement plan, because what do? You just created money that you can use in the future. So if you are unable to save money because savings is hard, you can invest in real estate. Real estate might be one of those things that you want to invest in, and it's going to help you tremendously. Store of value. Real estate is another one. It's a huge store of value. You can store value in real estate. Real estate is not one of those assets that's going to disappear overnight. You have the turnkey. Some people will tell me that in 2008, there was a meltdown. Yes, there was. There has been times when real estate has gone down. But if you think about real estate from a 30 years to 40 years perspective, there's no asset that has grown more value than real estate. No. And I'll show you why. And I'll show you, because I'll show you the return on investment on real estate, and then we'll talk about it. So another thing here we want to talk about is the components of real estate. We have 5 components of return on investment in real estate. And this is where it becomes really, really important. Number 1 is asset appreciation. When we talk about asset appreciation, I will do this. I will make this in the form of, I will show you another presentation. I'll go back to my whiteboard, and then we'll show you how this works. This is really where the magic is. Asset appreciation. You think about asset appreciation on real estate. The other thing you want to think about, mortgage reduction. Real estate is constantly appreciating. Mortgage reduction. It means that someone else is helping you reduce your mortgage, because what do? You're investing in passive activity. You're investing in something for somebody. Somebody's helping you reduce your mortgage, pay off your mortgage. You're getting cash flow out of the property. Another thing is huge tax savings. And then the big one, we'll talk about cost segregation. Let me explain this by going to the whiteboard. I'm just going to change our board here and take us to another board. where we would be able to see what I want to talk about here. So basically, I'm going to my other screen number 2. Okay, so think about this. Think about real estate as this. Let's take these 4 quadrants here. I'm going to, come on, 4 quadrants. These are 4 quadrants. On this first quadrant, you have something called appreciation of assets. On this other quadrant, the second quadrant, you have something called mortgage reduction. And I'll explain that to you. Reduction. On this other quadrant, you have tax savings. Let's see, tax savings. And on this other quadrant, what do you have? You have cash flow. Okay, these are the 4 primary ones. I'll talk to you about cost segregation in a bit. So when we talk about asset appreciation, let's look at this from this standpoint. And we're trying to determine your return on investment on real estate, and why I tell you that real estate gives you a huge return on investment. So basically, let's assume that you're buying a property. You want to buy a property. You're buying a property for the cost of the property. The initial cost of the property is $200,000. I mean, when you're buying a property for $200,000, let's say you give a 10% down payment, that's $20,000 is your cost of investment. That's what you're investing to get that property for $200,000. Now, when you have this cost of investment for $200,000, what are you doing? Other people have contributed. What is other people's money into this? It's what? $180,000 was given by other people. You contributed 20K, other people contributed 180K to give you this asset called 100%. So if you think about it over the last 30 years, statistics for the last 30 years tells you that real estate has grown at least at the rate of, they've grown consistently between 6 to 8%. 6 to 8% growth. If you say the asset value is appreciating at 6 to 8%. 6 to 8% means that if you take 6%, let's just play on 6%. 6% of that $200,000, 6.06 times $200,000. We're talking about $12,000 of growth every year, 12K. That 12K, remember that your investment in this property, your cost of investment is only $20,000. So if you take 12K over $20,000 divided by $20,000, so that return on investment just from that particular one standpoint is 60% return on investment. That's number one. That's the first element that you want to consider. The asset is appreciating at least 6% a year. So if it's appreciating at 6% a year and you only invested, let's say you're buying $200,000 worth of property, you only invested $20,000, it means that every year your asset is growing by $12,000. So $12,000 on your investment of $20,000, it's giving you a 60% return on investment. Now you're playing on $200,000 when you invested only $20,000. Number one, that's number one. Now, number two, they tell you about mortgage reduction. What is mortgage reduction? When you think about buying real estate, real property, there's a rule in real estate, especially for commercial property. They tell you the 1% rule. So basically, when you buy real estate, you're trying to cover cover 4 things: principal, interest, taxes, and insurance. So the principal of the mortgage, the interest, the taxes, and insurance, all of these things, those are the key things you want to cover. If let's assume that all of this, I know some people will tell me that there are additional expenses on real estate. Yes, but these are the main costs. These are the main expenses you incur on real estate when you buy the property, interest, tax, and insurance. Those are the big things. All the other expenses will play with them, other tax savings. So basically here, let's assume that you bought a property for $200,000. Let's assume minimum. You're losing, your mortgage is being paid to you. So a third party is paying all of this for you. It's paying your property, your interest, your taxes, and your insurance. Let's say they are paying, let's say your mortgage is going down by only $400,000, by $4,000 a year. $4,000 a year, you take that $4,000. Remember, your investment on this property was $20,000. So $4,000 divided by $20,000. What is that? That is about 2%. That's about 20%. $4,000 divided by $20,000. So you have a 20% return on investment here. That is number 2. So now you have your return on investment on that $20,000 that you invested. It's already 20 plus 60 is already 80%. Now let's go to tax savings. Tax savings is a huge one. But basically, I'm going to be as clear. I'll try to be as. So basically, when you think about here, there are so many things that you're putting into play here. What are you taking? You're paying rents, tax savings. This is here. When you're thinking about tax savings, you're thinking real estate is inherently loss-making. What are all the expenses that are going to make you make a loss? All those items that are going to make you, that you take into consideration that make you make a loss. First of all, you have rents. You have taxes on the property. You have what? You have interest on the property. You have insurance on the property. You have a big one, which is depreciation on the property. That's the big one. Depreciation. All these other expenses that you incur on your property, they are going to make you make a loss. Remember, you bought a property for $200,000. Let's say the general rule, when you think about it, the general, in most of the cases, I mean, in my firm, what we do generally, you see that real estate, people who are in real estate, they tend to make losses ranging from around 8K to 10K on properties. And why do you make these losses? The big one is you're taking all these expenses, you can write them off. And also the big one is depreciation. So you can take, even though you only invested $20,000, you can take that $200,000, that's the value of that property, and depreciate it and write it off immediately. That is why you see all these losses. Okay, let's assume that your loss, you only took the lower number, which is 8K. You took $8,000. $8,000 is the loss that you have on the property. Let's assume you are in the 30% tax bracket. You are in the 30% tax bracket. So it means that $88,000 times 0.3. So you're saving on that property, just for tax purposes, you're saving $2,400K, $400 is your tax savings. Tax savings. Those tax savings, these are your tax savings. You take that $2,400, you divide it by your investment. Your investment was 20K. That's your investment in this property. So now you're talking of 2,400 divided by 20K. That gives you an additional 12% return on investment. That's number 3. You are still thinking about your return on investment on the property. I say this because you cannot compare this. When you look at the return on investment of other properties like stocks, many people will tell you, no, I'm making losses on real estate. There is no loss on real estate. Let's look at this. So basically now you had 60,000 return on investment for appreciation. You have 60% return on investment from appreciation. You have 20% return on investment from mortgage reduction. Then now on tax savings, you have another 12% return on investment. And tax savings, remember I told you that how you can make a loss in taxes is not just 12%. We'll talk about more as we get there. Then the third one, the fourth item that you're looking at is cash flow. Real estate inherently it's not meant to give you cash flow. When you invest in real estate, you're investing for the long term. And this is what we're talking about here. You're investing for the long term. And let's assume that you made your 1%. You made your 1%. And then basically, let's take the lowest case. Lowest case scenario, you have somebody paying all these things for you. And then every year, let's assume that every year you're making every month, even if you're making, let's just say every month, you're making $200 from that property. After everything, you're making $200 from that property in cash. That is not, even though this is making a loss, remember, some of these losses don't really add, they are just paper losses because depreciation doesn't count. So basically, if you're taking $200 from that property every month, this adds up to how much per year? It gives you about $2,400 per year. That's how much you're taking in terms of cash from the property. If you're taking $2,400 from a property, 2,400, your investment, remember your investment, what was your investment? Your investment was $20,000. So 2,400 divided by $20,000, it will give you another 12% return on investment here. So basically, think about it. You have 4 elements. From asset appreciation, you had 60% return on investment, 60%. Then from mortgage reduction, you had 20%, right? Am I right? Let me make sure I'm taking the numbers right. 20% mortgage reduction, you had 20%. Then from tax savings, you had 12%. Then from cash flow, you have cash flow for another 12%. So what does that tell you? That tells you that you have 60 plus 80 plus 12 plus 12. Your return on investment, 60.6 0.6 plus 0.2 plus 0.12 plus 0.12. So you made a return on investment on this property for how much? For 104%, 104% return on investment. Now tell me what activity you can be making a return on investment consistently every year of 104%. There is none. I can tell you that. There is none that is going to give you a consistent 104% return on investment on your investment. I know people will tell me that it's not as easy as I say. Yes, it's not as easy as I say. One thing I'm going to tell you is that the risk on real estate is more when you start buying property. You have your first property, you're going to get risk on return. You're going to have higher risk. But when you start buying 20 elements of 20 properties, 30 properties, the risk is very, very low. The risk is low. I can talk about that. But the big thing I want to talk about here is something called cost segregation. That is the big thing I want to talk about here. When we talk about cost segregation, this is what is making people, I mean, we've talked about our return on investment. That return on investment on an annual basis is a no-brainer. You cannot beat it. First of all, you have real property. That's an asset that exists. It's not an asset that you can say it's going to be volatile. It's not like when you invest in stock, you don't even know what's happening. You don't have control over it. Here you have your turnkey. You can basically go into your property. Cost segregation here is the big thing that is making all of us, every person who is in real estate, not pay any taxes. Why? Let's assume that you are making, let's take you make $300,000 a year. That's your normal income from your W-2 income or whatever you're doing. You make $200,000, you make $300,000 a year from this. And then that's your income per year. Now, you have this $300,000. Normally, with $300,000, let's assume that you're in the 30% or let's say 30% tax bracket. Or even what? Let's say 30% tax bracket. You are a single person, you're a 30% tax bracket. $300,000 a year. What does that give you in taxes? Times 0.3. You're paying about $90,000 in taxes. 90K in taxes. Now, instead of that $90,000 in taxes, now you go out there, you go and invest in a property. Let's say you take $50,000 as your investment in a property. You put that as a down payment for a property. It's going to give you how much? $500,000 worth of real estate. Okay. Now you got $500,000 worth of real estate. This $500,000 worth of real estate, you were saying here that this 500, you are going to, when you do cost segregation, you're going to exclude land. Let's assume that land on this property is about 50K. Is the cost of land. It could be higher, it could be lower, depending on where you are. You have now 450K worth of assets on the land, worth of real property that is sitting on the land. This real property, the tax code in America, the tax code tells you that if you qualify as a real estate professional, or if you qualify for short-term rental loophole, you can take this 450. First of all, You book those things by component. You have a big property, you can break this down into smaller components. If you break this down into smaller components, you could take a third. That's the average. You could take up to a third of that number. What is a third of that number? It's 150, right? 150K. So this 150K, you could take it if you qualify as number one, real estate professional, which is something we can talk about. Number two, if you are taking this as a short-term rental and you want to take a short-term rental loophole, you can take this $150,000 immediately and write it, even though your investment, remember your investment in this property is just 50K. You only put 50K in this property. You had $500,000 worth of property. They are allowing you to be able to take that property, cost segregated, write off about a third of that property. Your income, you make 300K. That was your income. You were going to pay $90,000 in taxes because you are in the 30% tax bracket. Now they're telling you can take this 150K and then write it off immediately. 150K, write off immediately. It means that your taxable income is now 150K. That is your taxable income. What does it do for you? 150K, it brings you down now to you are no longer in the 30% tax bracket. You're now on this 150. You're now in the what? You're now in the maybe 19% or 20% tax bracket. Let's say 19% tax bracket. That's your margin. That's your effective tax rate. If you take 19%, 150. If you're married filing joint, it could even be less. Let's take 19%. Yeah, 19%. That's pretty high. But we take 150,000 times 0.19. So now your tax is 28,500. So now you just went from 90K to 28K. So how much did you save in taxes? You save yourself you save yourself $62,000 in taxes. Is it 62? Yeah, $62,000 in taxes just by one play, just by doing that. So real estate gives you that ability to be able. So in addition to what we just showed you over there, now you can take all of this and write it off. And some people, what they do is, instead of buying a $500,000 property, putting down 10% at $50,000, if you had taken these tax savings, because my program, I save you these taxes, and then I take these taxes, and then we buy real estate with it. If you had taken that 90K that you're going to pay in taxes, if you had taken the whole 90K and you put in property, instead of giving it to Uncle Sam, you take it, you buy real estate. You would have bought property worth 900K. And that 900K worth of property means that if you say that 100K is the value of land, then now you are now able to play with 800K worth of property on the land. Now, if you cost segregate this 1,800, you can take up to a third of it. Let me say 0.33 times what? Times 800,000. So basically, now you are able to write off $264,000 on your $300,000 income. So you can take this and bring it here. You now have 264 minus that. Now you're talking of 6 and you're talking about 3. So your taxable income is now only 36K. And with 36K, you are going to pay how much in taxes? You're almost going to pay nothing, because standard deduction is going to remove, if you're married filing joint, is another 25K. So now your taxable income on this money is how much? Is 11K. 11K means that you're paying almost zero in taxes. You're paying zero in taxes. Zero in taxes. So this, just because you did that one play, you're able to avoid taxes. You are a W-2 earner, which earned you this money. But because you are able to qualify through some of these loopholes, you are able to write off this. This is one of the biggest advantages you get with real estate. So investing in real estate, the wealthy invest in real estate because it's going to do what? It's going to save them on taxes. That's why you say the wealthy, they don't pay taxes because they play on the real estate game. That is what I wanted to. That's so important that I talk about that this afternoon. So hopefully that resonated with us and we saw value in it. Let me go back to my other screen so we can finish this presentation today. So I've shown you how cost segregation, how asset appreciation, mortgage reduction, cash flow, tax savings would save you. They gave you these three. When we did them, it gave you over 100% return on investment on your property. Now you have a property that you're playing with. You didn't pay nothing. You paid a 10% of it, and you're able to play this game. And not only that, the big one is cost segregation. If you qualify as a short-term, if you qualify for the as a real estate professional, which has made some criteria, or you take the short-term rental loophole, you can take advantage of all of this, and you'll never pay nothing in taxes, and you'll be building wealth beyond anything. So thank you for that. Let's see, what else are we talking about here? Yeah, so basically that's what I had for you today. I've shown you three things. I've shown you that investing in real estate will give you wealth. How does it give you wealth? It's going to multiply your assets. You're investing very little, but you're leveraging assets that belong to you. You're leveraging other people's money. Number two, you can actually save. I gave you all the advantage. You can save on that. It can really force you to save if you cannot save. You buy real estate, the real estate is going to be there. People are going to be staying in that. It's going to just be adding value to you. So basically, it's an store of value. It gives you an asset that you can control, and then it saves you significantly in taxes. I mean, you just go and on and on and on. And I can tell you, real estate is something that I haven't touched yet. I just touched a little bit. I mean, that's why I tell people, let's invest in real estate. Let's buy more real estate. The more we can buy these things, the more we can invest. And I'm going to tell you something. If you don't know this, when you buy your second real estate, it's going to be a risk. But when you start buying 10, 40, 30, and there are many rules, I'm going to show you also next time how you can basically buy 40 properties, many properties, investing nothing. And I'll show you how I do it, and I'll show you how you can do it the same. So basically, this is how we get access to me. If you were here and you thought this gave you value, you may access our company with following any of this website. This is the website. All this information is here for you for the taking. If you scan this, you're going to be able to join to book an exclusive discovery call with me, which is free. So thank you so much for being there today. Today I am not going to take questions. I don't know if any question that came. No question on the platform, which is great. I'm just gonna take this. If there's one question, I'm gonna take it, but I'm going to sum. I have a great. I'm just a little bit. I'm behind on everything, so I'm a little bit tense today. I have a lot of things in my mind. I just had to do this because I had planned for it, and I want to thank you, all those guys who turned up today. There's a lot, and maybe today I was a little bit. I didn't really give you but the value that I gave you in there. If you take it, listen to what I just told you. Take the value in there and implement it. It's gonna change your life. Investing in real estate could be a life changer. Everybody, every wealthy person I know, which I talk to a few, which I talk to, they invest in real estate. And we also are investing in real estate. And I want you to do the same. I want you to do the same. Thank you and have a blessed day. Bye-bye.